Good morning. Ron Janish here. Today is Valentine's Day, the 14th of February. And it's in California here, it's 8:14, which means the market opened in New York, about an hour and 3/4 ago. Is that right? Yeah, hours and 3/4. Anyway, this here's a chart of gold. It's just a nice little 15-minute chart. And it illustrates an interesting concept, and simply that after prices turn at the median line, it's not unusual for them to break out and then come back to the MLH, which is this line here, median line parallel, and then go further in the original direction, which might wind up happening here. In this particular video, we're going to talk about a number of concepts. One of them is how to increase profits and lower your risk. Yes, believe it or not, that does work out in combination. One of the things to understand is this, is that with the Andrews techniques, if you use the techniques properly, you can find the approximate location of where a reversal and when that reversal is going to be. So time and price, which is really kind of neat. The trick is anticipation and dealing with anticipation. And what Andrews would do, and let's see if we can find Andrews' picture here somewhere. There he is. There's Dr. Alan Andrews, the man who taught me a whole bunch of stuff that I know at the kitchen table, and he learned it from Roger Babson. So what Andrews would do is he would wait for the event to happen in many cases, and then put his buy signal in, or a sell signal, whatever the case may be. So for example, with this here, if he's expecting a reversal around here, he might put a buy over here, okay, which is still within a reasonable value of the turn, right? Since the turn was here, let's take a look at this on a daily chart. Okay, there we go. That's hard to see. Let's do 8-hour chart. Okay, here we go. So let's get rid of this one here. There we go. Okay. So he might look for a reversal at this point here, and then wait until it comes back on here. And if you look at if you have the expanded course, which is an incredible piece of work, you'll find that Andrews would send out his orders to his people who read his newsletter 3 or 4 days ahead of time of putting the orders in. So he would send it out on the newsletter on Thursday, and then on Monday they were to read these things to the broker. And this was quite amazing in many circles. And all he really did was he would see when an expected reversal came, say, expected reversal came, and then he would place an order where an expected pullback would be. Okay, that's what he did, and he reduced his risk in that way by waiting, by having the patience. Because if you don't have the patience and the faith, it's real easy for anxiety to jump in and you put in the orders too early. Okay, that's important. Now, in the course, one of the things that you learn, and let's go back to this page here for quickly. I gotta fix this, but if you go to andrewscourse.com and you click on precision, this thing here, you'll see what happens when you click on this. Boom. Okay, what happens is this sends this automatic email to this particular thing here at Yahoo Groups, and it gets you in a free discussion group. Now, if you're so inclined to take the course, you just click on products, and right there, you can do it real easy. That's the Advanced Andrews course, and afterwards, if you want to, you can take the expanded course, which is nearly 1,000 pages and 30, 40 videos of Andrew's material. And it's a massive, massive amount of work that was put into that by Dr. Andrews and myself. So anyway, what the course itself, in the course, what you learn are some techniques. And one of those techniques is knowing when there's a good probability of a strong move. Okay, now in this particular case here, notice it says here short 2, and this is a real live account. No funny money being used here. And so what we're looking for is a high probability of a strong move to the downside. And as indicated by Andrew's concepts, this would be one where I would put on an addition, and I did put on an additional position. Okay, whereas in the Canadian dollar, for example, this is all very nice and wonderful, but only have one position on, as you can see here. Okay, and in the New Zealand dollar, this has been going down for a ways, and what happens is sometimes you don't have a nice reversal signal at the exact top or at the exact test of the top, and it comes later on. Okay, and so let me show you, for example. Yeah. So what happened was we finally had a really low risk entry signal here, and it was, and you see it says 10 p.m. and here we go. Here it started going 12 a.m. Well, I'm not going to sit around and watch the market day and night, right? So what happened was we waited for it. See, got in at 71.81, which was about here. So we waited for the market to come back up for a while, and sure enough, this morning, boom, wound up getting short. Okay. And one of the things that's important is keeping an eye on these numbers here. Let's look at this in gold. That's an easy one. Okay. Notice here it says P&L day, and here it says P&L open. Well, there's a big difference, and this is because this position was put on yesterday. Simple as that. That's why there's a difference in the values, whereas in New Zealand dollar, this was put on today, so these will both be the same. And I don't know, many of you know who George Lane was, but George Lane was known for Lane stochastics, which, by the way, he did not invent. He just marketed it really well. And one of the things that he absolutely insisted on that people do is not go home with a losing trade. So in other words, you might keep an eye on P&L open and P&L day. Okay, that and in P&L open, you can see whether or not you have a winning or losing trade. Okay, so let's talk a little bit more about Dr. Andrews. Dr. Andrews was raised in Massachusetts, and his father was in the investment business, and he was known for taking care of investments for some really big people up there. And as you know, the Kennedys were up there and some other people. And Andrews lived in a home which had running water and servants and all that kind of stuff. And that was a pretty big deal at the time. And that all worked out and until he had a wife and children. And his children eventually turned out to be teenagers. And so he found that their attitude was one that he had trouble dealing with. So what he did was he moved the family into the barn. Now the barn had no running water, had no bathtubs, no servants, none of that good stuff. And they had to use an outhouse and stuff like that. And so his children really didn't like that when they went and approached their peers in high school, and so he had difficult times with them. Later on, Andrews wound up moving to Miami, and he was professor of engineering at the University of Miami, and he taught civil engineering. And by the way, he already was a multimillionaire when he went down to teach, because he made, during his, I think it's his first or second year or third year, something like that, in the markets after he graduated from MIT and Harvard, he wound up making his first $1 million. And this was as a cotton trader. And so later on in life, he wound up going down to Miami, teaching civil engineering, and he and his wife, and they really enjoyed that. And it was in the 60s, late 60s, that he started teaching the course by mail. And he found that the greatest way of advertising the course was to simply send out this newsletter. And in the newsletter, it gave you the orders for next Monday. So he'd send them out on Thursday and you get them next Monday. So that was kind of neat. And his way, I mean, his techniques, and you can see this in the expanded course, are known for finding not only where the turn will be, which in some cases is at the median line or median line parallel, stuff like that, but when that will be. And that's really kind of neat, having that combination of those two things. So now, one of the problems that we have in the Andrews course, we get people get really excited about finding this stuff out, and that can be kind of deadly, because if you put the order in at that price point and price doesn't turn there, it's like disappointment and bad feelings and stuff like that. So that's why you're better off using signals like he would, and you can even do this intraday. He would use what we call the MMLH, and he would very often wait for prices to turn and then use the MMLH for a reversal signal, and then ride with the signal for quite some time. Okay, so I hope that gives you greater insight. And one of the things, the questions that come up is can Andrews be done in a mechanical fashion intraday? And so here's what we did: was we took a whole bunch of Forex type things, and some of them we did 60 minutes, and some we did 4 hours, and we did a little test for the last a little over 2 years, and here's what we got, which yeah, if we put this in the proper date order, it would be better. Yeah, there we go. And so what happened was we got this. Now this is with leverage, and we also did some tests without the leverage. Let's see what happened without the leverage. This is leverage of 5x, which is fairly common in Forex. Let's see if we can find it. Yeah, here it is. Here it is without the leverage. And so here's a chart. There we go. Here's a little chart. And one thing you always want to watch is the down draw. In this case, without the leverage, the down draw was almost 2%. And this is what the chart looked like. Okay. So, and this is what it did and those kind of things. So, and this was a mechanical computer testing, not some human being picking points, which I imagine, would be even more successful. So anyway, I hope this gives you some idea. In this video, I put out some of the Andrews concepts. I've showed you how to get started by simply subscribing to an email group that has no charges, and we moderate it so you can put in whatever questions you want that are Andrews related. But if you're somebody who likes to sell Viagra, we're probably not going to approve that. So anyway, I thank you for your time and see you next time.